Hi everyone! Last week the stock indices largely moved sideways. It appears that expectations of a softer stance by the Fed will hardly help stocks start a steady rally. Although inflation is declining slowly but surely, there are many other burning issues. Currently, traders are worried about the possibility of default and the banking crisis. Regional lenders are struggling to stay afloat despite the government's aid. Stock indices kicked off a new week with a mixed dynamic. Investors are still digesting economic reports and following news on talks of the debt ceiling. President Joe Biden will resume talks with congressional leaders at the White House on Tuesday. Analysts expect positive shifts as the talks among staff have so far been productive. Apart from that, several Fed policymakers will deliver speeches. Bank of Atlanta Fed President Raphael Bostic said he does not expect any interest rate cuts this year. Watch our video review and learn more interesting details about stock trading. Let's start. Market uncertainty persists despite fresh economic data and speeches of Fed officials. When one issue seems more or less resolved, new ones appear. This is why speculators prefer sitting on the sidelines. There are high downside risks for stocks in May. The inflation report published last week did not stir up sharp price fluctuations. The reason for such a strange market reaction could be the fact that the fresh inflation figures will be revealed before the Fed meeting. However, traders will surely take notice of the recent report when opening new positions. In April, the consumer price index totaled 4.9% and unexpectedly turned out to be lower than the March indicator and expectations. Inflation has finally slowed down, not only because of a drop in oil prices from annual highs, which affected energy and input prices. The core CPI, which excludes food and energy prices, also decreased. It means that a decline in inflation was not driven by falling oil prices. Curiously enough, there were no consequences from money injections made in early March to mitigate the banking crisis. If these measures somewhat impacted prices, inflation figures for April would reveal it. Funds returned to depositors after bank runs remained inside the banking system. They were transferred to larger banks, so they were not used in the consumer market. Since early March, the Fed has been reducing its balance sheet. If it has grown since early March, it has decreased by the end of April. Hence, this step will not boost inflation in the future. The Fed's interest rate is now 5.25%. For the first time in many months, it has exceeded the inflation rate. The regulator no longer needs aggressive tightening. On the contrary, given a steady decline in inflation, the regulator could shift to a softer stance. Annual inflation now almost coincides with the annual interest rate. Previously, high consumer prices made it easier to service public debt. The Department of Treasury could pay its obligations with cheap money and even receive revenue from its loans. As a result, the growing public debt has become the main issue. The country is teetering on the verge of default. Besides, the ongoing banking crisis was also triggered by high key rates. Recession fears have not subsided. A recession may also occur because of aggressive tightening. High interest rates affect profitability, demand, and production. Therefore, market participants hope that Joe Biden and top Republican policymakers will be able to resolve a 3-month standoff of the debt ceiling at the next meeting. The most likely scenario is that lawmakers will extend the nation's debt ceiling through the end of the fiscal year on September 30th. All events signal that the Fed is likely to start cutting rates in the fall of 2023. Surprisingly, these factors did not improve risk appetite. Investors decided to take a wait-and-see approach. They have a point. Stock indices are trading sideways, especially the Dow. It showed the worst weekly performance, falling by more than 1%. On Monday, it lost more than others indices dropping by 60 points, while the S&P closed almost unchanged and the NASDAQ was trying to recover. This week, investors will mainly focus on the news about the debt ceiling. Treasury Secretary Janet Yellen said yesterday that the Biden administration and Republicans are making progress in negotiations. She expressed optimism that the negotiations could result in an agreement. Her words did not cause any reaction. Traders need actual shifts in talks, not promises. What's more, there are no strong drivers that could facilitate an upward movement. This is why investors are trying to predict medium-term movements. Meanwhile, PacWest shares fell by 3%. On Monday, they continued their downward movement. Tesla stock tumbled by 2.4% at the end of last week. The company quietly increased the prices of its Model X and Model S cars in the US. Elon Musk chose a new Twitter CEO. The S&P shed 0.3% last week. On Monday, it closed almost flat. It made several attempts to enter positive territory. Looking at the long-term dynamic of the S&P, the index has been stuck in the same range for about 6 months. Both downward or upward scenarios are possible. If bears take the upper hand, the index could decrease to 3,800. If bulls prevail, the S&P may break through 4,150 and then jump to 4,300. However, its growth could stop at 4,050. Given the market uncertainty, investors' cautious approach is quite reasonable. A soft landing scenario will enable the S&P to rise to 4,400 by the end of the year, logging 7% growth. If the US slides into recession, the index may fall to 3,300, which is a 20% decline. The majority of analysts believe that a mild recession may bolster a bullish sentiment in the US stock market. Currently, bulls are unable to take control. They failed to push the index above the key resistance level. As a result, the S&P retreated to 4,195. Unlike other benchmark stock indices, the NASDAQ 100 scored gains, albeit modest ones. Its weekly rise amounted to 0.4%. On Monday, it also managed to inch up. Nevertheless, the index is also trapped in the sideways range. It will hardly be able to escape it in the near future as market uncertainty is mounting. Traders are unwilling to take risks in such market conditions. As negotiations of the debt ceiling are in full swing, investors are more focused on long-term prospects. They could even leave the market for some time and return when a sentiment is more or less clear. The deadline for making a decision on the debt ceiling is June 1st. After that, there is a risk of a default in the United States. If it takes place, it will be a disaster for the economy. It may lead to devastating consequences. As for the earnings reports, it is important to pay attention to the revenue results of the three companies. PayPal shares sank by almost 12% after the publication of quarterly results. The report was not weak, but revenue forecast for 2023 came short of analysts' estimates. Electronic Arts also unveiled an upbeat earnings report. Analysts recommend Electronic Arts shares as hold. Walt Disney's revenue grew by 13%. However, a decline in the global advertising market affected profits from cable TV and television broadcasting. It decreased by 7%. Analysts recommend buying the company's shares. However, on Thursday, shares fell by 6% to $92. There were risks of a fall to $84. The stock market became volatile after Elon Musk said he had found a new CEO for Twitter. Some investors considered it a positive factor. Musk will be able to pay more attention to Tesla. Besides, the company's shareholders have been asking him for so long to focus on issues that Tesla is facing now. Others believe that it is too early to rejoice, as it may benefit Tesla to some extent. Musk may be more involved in other projects, such as a new startup, XA. That is all for now. Subscribe to our channel and stay up to date with the latest market news. See you!